We are on. What's going on, guys? It's the Money Talk Show with Dane, where we talk about all sorts of interesting topics having to do with money. So if those are topics that interest you, make sure that you like this video, subscribe to the channel. Me and Corey are putting out content every single day to be able to help you guys understand the crypto world, how to navigate it, how you can plug in, you get in where you fit in, all that type of stuff. So we appreciate you guys jumping on, and we've got some really cool stuff to go through today. But of course, before we jump into that, Corey, go ahead and intro yourself.
Yeah, Corey Gary. My YouTube channel is Crypto Millionaires with Corey Gary, and I'm a real estate investor. My previous life, I'm a real estate investor. I'm just rapidly switching over to a crypto investor, and my mission and goal is to bring the real estate space with me, people who I know and love in the space, to be able to give them and teach them some exposure into this beautiful asset class that we call crypto, because I truly believe this is where the next big shift of legacy wealth and money will happen. So yeah, man, that's my story, and just happy to be here to be able to provide as much value as possible.
Awesome. And today we have Alan Walker joining us. Alan is one of my good friends here locally that we've met from real estate investing. Alan has a pretty cool story in regards to being involved in crypto very early on. Alan, go ahead and tell us about yourself. If you give us a little bit of your background as far as investing is concerned, of course, you know, how you stumbled into crypto, and then we'll talk a little bit about what you're doing today.
Yeah, I think it's funny. All three of us are real estate going into crypto guys. So my background is I started out as a software developer for about 15 years, and I got involved in Bitcoin back in 2013. In fact, it's funny. I remember when it hit $1,000. I was at a Bitcoin conference, and everybody was losing their minds, which is hilarious to think about now, right? Like it hit 1,000, and then it plummeted back down really fast. So I ran the Bitcoin meetups here in Salt Lake for about 2 years, and then I kind of wandered away from it. And I wandered away because at the time it was so new that only developers could do anything, and it was very rudimentary. There was no user interfaces. There was Coinbase, I think, came out in 2014, but that was about like the most that was there, and you couldn't do anything with it. I mean, it was just strictly you buy it on Coinbase, it sits in Coinbase, and you just wait. So I wandered away.
You were buying pizzas with it?
No, I was not buying pizzas with it. Yeah, I actually met that guy at that conference. Actually,
really?
Paid $10,000 for a pizza. Yeah. So I wandered away, and I found real estate, and had done well in real estate and been in that for about 6 years. And about 2 years ago, I could see that the landscape had finally shifted so that there was more application for crypto than there had been previously in the past. And so I kind of got back into it and started researching it more, and really got into the DeFi space really heavily, just because I think that really is the future of the financial system. So yeah, that's been my journey up to now.
Awesome, man. Well, we're pumped to have you on. Talk a little bit about when you were buying Bitcoin early on. What did that look like? I think it's important to line out to give perspective to people that are going to watch this.
Yeah, were you buying it from Mt. Gox?
No, luckily I was not buying it from Mt. Gox. Here's the funny thing. What would happen is that we'd get together at these meetups, and people would say, "Who wants to buy Bitcoin?" And then people would walk up to them, and then they would just send wallets, and usually with cash, just hand cash to another person, which felt very drug deal like. So I'll meet you at this parking lot, and I'll throw you a 20. You can give me some Bitcoin. So it was. It was clunky. It was very hard to figure out. I was a tech guy, and I was still struggling with how to make it all work. And then once Coinbase came out, that was the start of a sea shift in terms of how you could do it, because then it was connect to my bank account, and now I just it's a debit transfer and done. But yeah, it was. I remember there was a pizza place here in Salt Lake that accepted it, and they had and they also had a Bitcoin ATM. This is probably 2014, 2015, and just learning how to get them the money was so difficult. It's people have to bring a laptop. They didn't know real way of doing it. So it's come a long way since then.
Interesting. No, that's great. So yeah, man, let's talk a little bit about what you're doing today specifically. Let's jump into liquidity providing. I've been really fascinated to talk to you about what you've been doing there. I think there's a lot of content that I've seen on YouTube where people are trying to provide information about liquidity providing. I think a lot of people are irresponsible in, you know, how they try to liquidity provide. A lot of people get wrecked when they try to get in. So I'd love to.
Crypto people aping into something without really knowing about it. What?
God forbid. No, I can't imagine.
That doesn't happen.
Yeah. So talk to us about how you ended up in liquidity providing and what you're doing there. Why you're interested in that part of crypto.
Yeah, you know, one of the things that I've realized with crypto is there's a new technology, but a lot of the fundamental principles are the same. And so I was looking for parallels in the real world and crypto in terms of how you make money. And so, you know, looking at my real estate stuff and thinking through like, okay, how can you make money? We could be a hard money lender. You could flip houses. You could have a rental to get like monthly income. Like there, you know, there's all of these standard ways. And so I thought there must be something similar in crypto. And really what it was there must be a way I can provide a service and get paid for the service without selling my asset. That's really how I thought of it, right? Like if you have a house, like you still own the house, but you get paid every month, someone else is using it. And long-term, you're going to have appreciation. And so I started looking into DeFi and realized that yield farming has the potential of acting the same way, right? I'm providing, it's almost like a hard money lender. I'm providing money as the asset. I'm getting paid for the use of that money, and then I can take the money back at any time. The biggest difference for me was it doesn't have to be a huge amount of money, right? Like in real estate, like, you know, I'd love to say we could get into houses for nothing, but like, you know, we're spending a chunk of money when we get into a house. And many times the return is better, and there's no like toilets, tenants, headaches, property management, you know, there's all the stuff. Yes. And I started thinking like, wow, like this is really a way, if done correctly, to create an income generating asset that I can have inside of crypto. And so that was really what started moving me in that direction, because it made sense. I mean, it's difficult for me and maybe others, it's sometimes difficult to understand like the tokenomics of something and why it's going to go up, and if it's sustained growth or if it's a pump and dump, right? So this just made sense to me. I was like, okay, yeah, I'm providing a service. I get paid for a service. Great. Like that's really straightforward. I mean, there are always risks in any kind of investing. I'm not saying that yield farming is somehow perfect, but I do think that I found that it gives you the ability to build a cash generating machine over time. It's not a get rich quick by any means, but yeah.
I love that. Let's unwrap that just a little bit, because in blockchain, people don't realize, everyone thinks that like crypto is a scam, that, you know, we're paying, you know, old investors with new investors money, and it's not. There's so many different ways to provide a service, like you said, and get paid through this. And like a lot of the projects that me and Dane are involved in is almost like owning an online business where we're getting paid from the fees of trading, or getting paid fees from an auction house or something. So it's almost like getting stock dividends. And so like people don't understand, I think, because it's just been beaten to death with like the FTX stuff and all this, the Luna crash, and that there's more to crypto than just paying old investors with new investors, Ponzi type schemes, that you actually can make money providing a service in crypto. And I think that really has to be talked about a lot more, especially what the demographics that we're trying to educate. Because, you know, like real estate people, they just don't understand. They think crypto is a scam because all they see is the headlines. And so we have to really emphasize on that very small concept that, you know, that this is real utility now. This is real world use case that we're doing on the blockchain that we can do in real life too. And that's why I'm especially in love with crypto right now, and the way it's evolving into this landscape. It's beautiful. And so that's why it's so amazing. So I really want to touch on that.
Yeah, it's funny, the FTX thing, you know, everybody keeps coming to me asking about it, and they're like, well, crypto's bad. I'm like, it's fraud. Fraud happens in any industry. Like, you know, it's like, do you remember Bernie Madoff? Like, it's fraud. So like that's not a technology issue. It's like people willingly did bad things.
The media just pounds it in people's head that like that is crypto, right? Like that is people who never even heard of Sam Bankman-Fried or FTX now, like everyone knows about it. Like my dad knows who Sam Bankman-Fried is. My dad,
why are they saying SBF all the time? Yeah.
Right. He has no clue what crypto is. And like he knows about this guy now. And it's like, oh my God, it's just like it's so bad. But you're absolutely right. There's fraud in everything. Look at real estate. There was so much fraud in real estate that, that's why we have these 12, 14, 18-page contracts now, and all these lawyers who are wealthy as crap because, there's so much fraud in real estate. And so it's just it's like any niche, man. And you just need to educate yourself. And that's how you avoid the landscapes, or the landmines. Sorry, the landmines.
Yeah.
And it's through education.
Right.
I think also like part of it is, oh, sorry, Dane, go ahead.
Oh, no, go ahead and finish up, Alan, and then let's jump into some of the nuts and bolts of how you're doing liquidity providing. That'll be fun to go through. And specifically, anybody that's watching this live, feel free to post your comments of any questions that you have from Alan as we go through his strategy and what he's doing. And what we're really hoping is Alan to be able to have some actionable information that if people wanted to start dipping their toes into liquidity providing, how they could get started, what to do, how to approach it, the mindset behind it, all that type of stuff.
Yeah, absolutely. All I was going to say around just the FTX, Terra Luna, like Celsius, this is just one more reason to believe in decentralized finance, right? Because
100%.
all of those were centralized organizations. And so people come to me and it's like, well, yeah, if you're only interacting with smart contracts, you're a lot more protected. It's not 100%, but like nobody's in there necessarily messing with it like FTX was or so, like none of that's happening. So just it's one more reason to go into DeFi because you have better control of your money and you're able to use it how you want to use it instead of letting some person have custody of it.
DeFi gets rid of counterparty risk, and that was why crypto was invented. So it's
Yep. Yeah. So Dane, what would you like me to talk about around yield farming and liquidity providing?
So give a good analogy of, well, I think let's start with when you say that you're providing a service, talk about that more. I think you did a good job with explaining or relating it to hard money lending. Talk about that a little bit more. Just give our guys that are watching this a real simple idea of what it is when you mean you're providing a service. And then we'll jump into some of the nuts and bolts of what that actually looks like.
Sure. Yeah, I think so. The big difference is really, as I was talking about, between centralized and decentralized. So centralized exchanges like Coinbase or FTX or whatever, they're holding all your money, they're doing all that they want to do, and they're collecting all the fees, right? You really are very passive in terms, and you have to believe what they tell you have. The big difference with decentralized exchanges or DEXs is that they in themselves do not provide any liquidity. So in order for the exchange to work, they have to attract people to come in and put their money in the exchange to be used so that the exchange can function. And that's really the fundamental idea to hold on to is they're made for the general public to come in and provide liquidity. They do not have any on their own. So when you're going to an exchange, they're essentially saying like, hey, we will give you a specific APR that changes, but I will give you a certain APR. Let's say I'll give you a 40% APR if you put your liquidity tokens inside of my exchange. And where they're getting the money for that is from transaction fees. So a portion of all trading transaction fees goes back to the people that are providing liquidity. I mean, that's the incentive, right? Like we'll attract you by saying you're going to get this great return. In exchange, we'll pull money out of the trading fees because the DEX doesn't hold any money and we'll give that to you. And so the driving factors around those APRs is really volume on the exchange and the demand for that pair. Right. So if more people are like making those trades, the people that are in that pair are going to get more of the transaction fees.
Perfect. That was great. So let's get into some of the nuts and bolts of how you're actually doing that. What does yield farming look like for Alan? Let's talk about where you started when you first jumped into liquidity providing, and I think it's really useful to see the evolution of where you started and kind of where you're at in regards to what you're doing with your yield farming.
Maybe some mistakes that you've made along the way.
Yep. Yeah, I have. So where I first started was I was looking, I had a bunch of HEX. So I went on to Uniswap and just had like a hex. I don't remember what the other side of the pair was, but I was just providing someone hex. That was really just me learning what to do because I had a bunch of hex and I didn't know what to do with it. And I thought, well, I mean, this is like, do I want it to sit in the bank, my wallet, or do I want it to actually earn
Well, you
some
could have staked
revenue?
it.
Yeah, no, I could have staked it, but I think what I had already staked a bunch, and what I was trying
Okay,
to figure out is
perfect.
like, well, how can I be more liquid in this investment, right? With staking, it's like
And
you're
make
waiting,
money.
right? Like you're staking it and you're just sitting there waiting for it to happen. So with yield farming, you're getting paid every second, right? Like it's constant, and you can pull your money out whenever you want. There's never an issue with that. So for me, I was looking at it in those terms, like, well, okay, this is more liquid. I'm getting paid right away, so I can take those returns and invest them somewhere else immediately. I don't have to wait this long period to do it. And so I started on with Hex. And what I found was that the Ethereum blockchain gas fees really are detrimental to your investing when it comes to yield farming, because every time, so some terminology here. So I don't know who came up with this. Every site seems to want to be cute. And so someone decided that they were going to be called farms, and you were going to like put your money into a farm and then you would harvest your money to pull out the rewards. So that is the term that's now like, ubiquitous. So I started there, and then I realized I'm not making any money, and I'm not making any money because of the gas fees. So I went looking for other chains to find like where I could find more yield. And I found the BSC blockchain by far, and I guess it's now BNB blockchain, is that is by far like it's the second biggest chain from what I've seen next to Ethereum that does yield farming.
Yep.
And so there's a lot of volume on it. There's a lot of people on it. And so I thought, okay, well, there's lots of liquidity on this chain. There's lots of people that are using these exchanges, and so I'll go over to there. And so I moved over there, and I started using two DEXs, or decentralized exchanges. I started with NightSwap, Night like Knights of the Round Table, and PancakeSwap. And so I just started playing around, and the biggest fear everyone has is losing money, right? Like that's everyone's fear in anything, but especially in crypto. It's like the number one thing that everyone's freaked out about. So I started with just a stable pair, and a stable pair just means that any liquidity. So what you're doing is you're taking two different coins of the same US dollar value, and you're putting them together and you're dropping them in this farm. I decided that I was going to start with two stable coins. So I had like USDT and BUSD, which are just two coins. They're pegged to the US dollar, right? So you can't lose your initial investment. And that was what I was most concerned about, right? So I put those together and I dropped them in. The issue is just like in the real world, if you buy treasury bonds, they're very safe, but you don't get a lot of return. And so I started to branch into some other farms, and I started thinking about, well, what are the fundamental pairs that make this exchange run? Because if I can just start with investing in those fundamental pairs, then the chances of me losing a ton of money is less, right? So usually when you look at those exchanges, like PancakeSwap has them, all of them have like these three main liquidity pairs. They've got a DEX token, which is the token that is the reward token on the exchange. They've got a layer one token, which is the native coin for whatever blockchain you're on, so BNB in the case I'm talking about. And then they have a stable DEX and a layer one DEX. So I just start with those three. And if you look on most of these exchanges, those are the three highest providing or highest APRs, unless it's a really like unique coin that doesn't have a lot of liquidity. But that's all express, right? Like that's done on purpose so that you put your money in there because they need those three in order to actually make the whole thing run.
What are those three? I'll you just recap. What are those three on BNB, for instance?
Yeah. So if I'm on PancakeSwap, the first thing you want to ask yourself is, what is the DEX token? And the DEX token is what you get as a reward. So you're not being paid back necessarily in the two coins that you put in. You're being paid back in this third token. So the DEX token on PancakeSwap is cake. So okay, and then it's on the BNB smart chain. So BNB is the layer one. So the main, like almost every time, I don't say every time because it's crypto, who knows, but almost every time I've ever gone, the highest yielding one that has a large multiplier, which just means it's giving you more of a return, is going to be that layer one DEX token, because that's the main pair for the entire exchange. So I start with that one. So that'd be Cake BNB. And then I just split those and pair them with the stable coin. So it's DEX stable and it's layer 1 stable. And those are the three right there. So you get, the highest yield is typically that first one. And then you get a lower yield, but still a really good one for the DEX stable. And then you get a decent yield, but it's for the layer 1 and stable. And it's important to understand why. So a DEX token only sits on that exchange, right? Like Cake is on the Pancake Swap exchange. That's it. So it's more volatile, even though Pancake has like $4 billion in total value locked. But it only Cake is only happening there. So it's going to be more volatile because there's only one place that you buy and sell Cake. Whereas when you're looking at like a stable and a layer 1, well, there's tons of people using the BNB chain and they all have to buy BNB in order to use anything. So that price is a lot more stable. It's not totally stable, but it's a lot more stable. And so that's how you have those tiers, right, of APRs. You've got that first tier that's got both sides of the coins are fluctuating, right? Like you've got BNB and Cake, both of those can change value. And so that you get a higher reward for that because there's more risk in the pair. Whereas as you go down that chain, you've got one side that's a stable coin and the other side that's volatile. So they're semi-stable coins or semi-stable pairs. And so those are going to be a little bit less volatile. And that's why you get a little bit less of a return on them. But if you just start with those three, that's a great place to start.
Okay, cool. And that's excellent. So if we were on the Binance Smart Chain and we were to start with the three pairs, the ones that you're mentioning here would be your Cake and BNB pair. That's the DEX token and the reward token. The other pairs would be like BUSD, which is a stable, and BNB, and BUSD and Cake.
Yep, that's right. Yeah,
cool.
Exactly.
How would you split them? Would you allocate, if you had a certain amount of money, would it be 33% in each one of these pools? Would you do it differently? Do you have any insights there?
Yeah, one of the things that I found is portfolio allocation based on risk, like focusing on risk mitigation when it comes to your yield is the best way to go. So I always have the fourth, I call it the core four. It's those three plus a stable. And I usually how I'll do it is if I look at my portfolio, depending on the number one question you have to ask yourself is when am I expecting to pull all this money out? Because the timeline really matters, because if you have too short of a timeline, you're going to be staring at it all day and you're going to freak yourself out and it'll dip a little bit and you'll pull everything out and lock in your loss, right? So I always say, like, hey, if you're going to do this, plan on 12 to 24 months that you're going to be in there and know that ahead of time so that you're not freaking yourself out when the market does exactly what the market always does, which is go up and down. So I usually say, like, hey, if you're starting out, put 60% in that stable coin pair because it's going to protect your downside. And then I'll usually do like 25% in the Cake BNB, that main pair, because it's got a lot of APR. And then I just split the other 25 or the other 15% between the other two.
Cool.
Nice. So you break it up based on your risk tolerance.
Exactly. Yeah.
I love that. I love it. And that's everyone else's risk tolerance will be a little bit differently. Like I have a very high risk tolerance, or someone else, will have a very low risk tolerance, and they might want to go into the more stables.
It's a great place to start because then you're not as afraid, right? Like you can, because a lot of it too is like you have to build the muscle of doing this and being familiar with how it all works.
You can see how it works.
Yeah. Like, and then
you're like, oh, I see that now. It makes sense to me. It's like,
absolutely. Yeah. Even people getting into yield farming, I often recommend just start with $1,000 because it's enough money that you can see some return, but it's not so much that you're going to be living under a bridge, right? I mean, it would hurt, but if you lost $1,000, you're not going to like jump off a cliff. So, I always say, like, start with 1,000 and like start with those allocations. And then what I've found is people naturally put in more money as they get more comfortable, right? So like they'll do it for a little while. They understand how it works. Like, okay, now I can send in $5,000 or now I can send in $10,000. But like I always say, just like don't start with that because you'll immediately stress yourself out about every move you make if you put in a whole bunch of money to start. So it's start slow and then build.
I like it. That's cool. And so we've talked a lot about the BNB chain. Is that, are you yield farming anywhere else? Is that the main place? Talk a little bit about that.
Yeah, I'm also yield farming on Phantom, and I'm also yield farming on Polygon. Both of those are a lot newer than the BNB Smart Chain. And so they're, some of the rewards are a little bit bigger, but you have a little bit more impermanent loss risk because like they're just newer. And so
talk about permanent loss a little bit, because I'm sure most of our audience doesn't even know what that is.
Yeah, absolutely. So, like I said, any investment is going to have some kind of risk, right? That's why you get a reward. And so there is a risk in yield farming when you're not in a stable liquidity pair, because it means that the US dollar value of your tokens can fluctuate. And it's important to mention it in the context of the reason you have this liquidity pair is to get yield. It's not necessarily like now it's a great bonus if the liquidity pair tokens go up in value, because say both coins that are part of it, BNB and Cake, for example, those both go up. Well, then your liquidity pair goes up because the price of it is based on what the underlying assets are. So the risk that you run is, let's say you've got a liquidity pair, Cake and BNB, and you're getting a great yield, and then Cake drops by $1. Well, you're going to see a substantial drop in your amount of value. Well, Cake's $3 ish right now, so like that's about a 33% drop in Cake. So you're going to see a drop in the US dollar value. You didn't actually lose any money. You have the same exact number of liquidity pair tokens that you started with. It's just that those tokens are worth less. And so that's the risk that you run, is that you pull your money out before it's recovered. And so you've lost part of your principal, even though you've been getting yield the whole time. But you've lost part of your principal because the value of one of the coins or both of the coins has gone down. The thing that nobody ever, like everyone wants to say that and they get all freaked out, but then they're like happy as pie when both sides go up and all of a sudden their yield tokens are worth twice as much as they were previously. But it's important to know what you're getting into, right? Like there is a risk. And that's why I think start with stables. Like just start that and understand it. And then you'll start going to other stuff. I mean, I search out more exotic pairs, because if there's not a ton of liquidity and that coin is having, like one of the coins is having some kind of big pump, then I want to be in that pair, not long term, but I want to be in that pair because if you're buying or selling, so even all throughout a pump and dump, you're getting paid as a liquidity partner, right? So sometimes I'll do that, but those are typically 1 to 2 weeks versus my long-term stuff that's 12 to 24 months, right? So you can get a little more day tradey with it. I don't like doing that. I'm not a day trader. But there are, you can get, I've gotten like 300% APY on some of my coins, but the APY never lasts, right? That's why I say you have to, because it's all a function of who's providing liquidity and what's the demand for the coin. And when somebody sees a 300% APR, they get in, which automatically drops the APR. Yeah, the crowd rushes in to provide liquidity, and then the APR drops because now there's too much liquidity. Yep.
Let's talk about a little bit. So I've been providing a little bit of liquidity. I've been playing the game a little bit. I'm learning. I'm in the learning phase of doing liquidity. And I don't mind when both of my pairs drop down in value. I'm actually okay with that. I have a high risk tolerance. I know what I'm doing. They move up and down. I'm fine. What I really don't like is when I have impermanent loss from one against the other. So like this one goes up, this one goes down, and then in the end of the movie, I'm stuck with all of one coin and not in the other. And I haven't quite cracked that code on how to adjust the right ranges at the right time. How do I know when one's moving up against the other? I mean, I'm not a trader, like you said, and maybe I am setting my ranges too tight because I'm trying to get more fees, which you could do on, because I do it on Ethereum with V3. And so maybe talk just a little about that and how to maybe mitigate a little bit of that impermanent loss when they run against each other.
So the important thing to realize when it comes to these liquidity pairs is that the function of the liquidity pair is to keep an equal amount of US dollar value of those tokens against each other, right? And so if one goes down, you're actually selling the higher value one to buy more of the lower value one so that the US dollar value comes back in alignment. So I don't typically, personally, I don't use ranges because it takes too much administration for me. Checking to make sure it's still in range, making sure you have to break it up, you have to start a new one,
daily.
So for me, it's I don't want to do that. Like I look at my crypto once a week. I take about 30 minutes to do all my yield farming, and then I'm on to the rest of my life, right? Like I don't like to be, now some people, I mean, you make more money, right? Like I'm not saying like it's a valid way of doing it. It's just not my preference, right?
Yeah.
So for me, I'm typically looking at, like, I am thinking about the APR, because if we look at, like, if I have something for a year, and we're in a bear market right now, so it's hard to say a year ago and then look at now, because everything in crypto has gone down dramatically. But I typically think, okay, I set some rules up, and I think that's the most important thing. Like you seem to have good control over your emotion when you're seeing these fluctuations in price. The vast majority, like most people, don't think they're most people. So most people are really overrun with emotions, and so when they see that fluctuation, they just like get out. What I often counsel is like, hey, if you're holding this for 12 months and it's 2 months in and it's dropped in value, does it make sense for you to do anything, or should you just hold it, right? And I mean that in terms of, like, if you're staying in like the core four that I talked about earlier, then like those are fundamental to the DEX. So those are going to recover one way or the other because they're so necessary for the DEX to work. So I typically am not looking at like when that happens. I mean, like, yes, I mean, I've never had anything go to zero, but that's the risk, right? If one of your coins was like $10 and it goes to $1, or excuse me, down to a penny, then like everything is that coin now, and you only have this tiny little bit of like the other coin on the other side of the pair. So it's a risk, but it's a risk that I feel like I'll monitor it. I mean, having rules is one of the most important things you can do when it comes to yield farming. I mean, really any investment, right? But being able to say, I'm going to hold it for this long. If it goes up by X%, I'm going to do this. If it goes down by X%, I'm going to do this. And if the APR drops below a certain point, I'm going to do this, right? 4 simple rules just to guide what you're going to do, because then you have guardrails, like bumpers, like at the bowling alley, right? Like you've got bumpers against what's going on. And so like if something happens, I don't have to worry about it until it hits this point, or I don't have to like take out some money just to like deleverage my risk until it gets to a certain point, right? So that's typically how I look at it.
I love it. I love it. I think one of my issues was I was just setting way too tight of a range. Like you said, I had to get in there every single day and manage the liquidity position and readjust the range. And then, I go to sleep at night. I'd wake up and one pair would be all in the other one. I would have all in one.
Right.
I'm like, okay.
Yeah.
So it's learning lessons, and I'm okay with learning the lessons, because I love this, this asset class. So I want to learn as much about it as I possibly can. And so, yeah, that's very insightful. So thank you. Yeah. Huh. So you don't do any V3 then, obviously, on Ethereum, or you haven't played with V3, adjusting ranges and stuff like that. You're just doing the 50-50.
Well, I've played with it, but I just found that it wasn't for me.
Yeah.
That's really what it was. Like when I was getting in there, like I was playing, I think it was Hex and Hedron, maybe it was the pair, I don't remember. But like I did play with those ranges, and it just I just found it took too much time.
I'll tell you what,
I didn't want to worry about it.
What's a really good pair when they're meet and peg is Hex and Icosa. Because
I've heard that actually. Yeah,
they run together, and actually Icosa is now starting to come back up and meet its peg again, which is nice. We're only about 20% away from the peg now, but they usually rock together, and that's a 1% pool, which is a very high, So I might play around with that pair again. Maybe if we get experience in another leg down, I think that's another thing to take into consideration where we're at in the market. Because if you start doing liquidity providing after we've kind of capitulated, then like your impermanent losses risk is a lot less, right? So I think that's the one pair that I'm going to start playing with again. I think I've learned my lesson about setting too tight on the pair, and interesting. I love it. I love it.
And Alan, on the BNB chain, so Corey's talking about setting ranges when you're on Uniswap, on Ethereum, on BNB with PancakeSwap, you're not setting any ranges. And so you don't have to worry about having to reset anything. You just put in the liquidity, and your main concern, or maybe it's not, but I guess the main concern in my head that you're evaluating there is the impermanent loss, right? Have the coins run different, so now they're out of whack. And when it's time to pull liquidity, the hope is that you're pulling out once they've ideally come back to some sort of relative balance, plus factoring in your yield, and you're at a place where you're in profit, right?
Yeah, and the big thing to keep in mind when it comes to yield farming is it's really the power of compounding that allows you to get like extraordinary returns over the long term. And so they usually will have some kind of calculator to show like if you compound it daily, it's this. This is the APY. If it's weekly, it's this. I found that there's not a big enough difference between daily and weekly for me to say I'll commit to doing it daily, because I won't. But what I found is like I just take my yield out, and many times I'm just like compounding it back into the pair. And the nice thing that's about that is, let's say cake is now like $1, and the output is actually based on what the US dollar value of the cake would be at the time, right? So you're getting this yield, and cake's worth $1. And then as cake goes back up, if you've been compounding, your whole liquidity per token is flying up, and you have more liquidity per tokens because you've reinvested the yield back in that pair. And so one of the things that's also important to remember is there are pools within yield farming. And what that means is, so a DEX does not want you to sell the DEX token, because if everybody sold the DEX token the moment they got it as reward, then there would be no value in the DEX token, right? And the DEX token is what allows the DEX to stay in business, the value of the DEX token. And so what they do is they incentivize you to stake your DEX token in return for a tertiary token, right? So you've got your liquidity pair, you've got your reward token, and now you've got this third token. And you're not selling, I mean, just like staking, you're not selling your DEX token, it's still yours. And so that actually also allows you to build a lot more wealth, because think about it, if you just sold that tertiary token for passive income, then there is a never-ending stream, right? Because you're always getting your yield from the liquidity pair, you're putting even more DEX token into the pool, you're getting even more tertiary token. And so like every week, all of that augments, right? And so over time, that's where you can really develop this passive income stream by using those. That's one of the things that's just not possible anywhere else, right? To have like a DEX token that actually you hold on to, but you get these free tokens on top of it, right? Because you've already been paid for the liquidity pair. You got paid in the DEX token, and you still own the DEX token. So now this is like just a free asset that you can get.
I like that. So your evolution, let's talk a little bit about your evolution with your yield farming. So you started, I'm assuming you've built from experience over time your core four, or that philosophy. Yep. And you have those working, and then it's evolved to where, like you're saying, not only are you earning the DEX token now for providing liquidity, but you can go and use that DEX token. I believe on PancakeSwap, are you using that DEX token and doing single-sided staking with the cake token to earn the tertiary tokens, or are you LPing that cake token with something else in order to earn the tertiaries?
No, it's single-sided. So all of the pools take the DEX token. So all the pools on PancakeSwap take cake. The output is what differs. What I actually like to do is I like to put my initial yield into a cake pool that is, and they use like pretty good returns on them, and then take that yielded cake and put it into another pool. Because then I'm making a yield on just holding my cake, and that yield continues to grow. And so that yield continues to go into different pools. And again, you're not selling anything. So like all of this money is just staying in your pocket the whole time. So yeah, I mean, that's usually what I'll do. Because I look at the cake pool as just a multiplier, right? Because it's saying like, hey, if you drop your cake in here, I'll give you a 40% return on it. So you're getting an additional free 40% of cake on anything that you're holding. And then you can take that cake to get even more money. So it really, like, over time, that's why I say compounding and your timeline is what matters when it comes to yield farming. It's not the day-to-day fluctuations of the LP. If you're staying in like core LPs that like are always going to have volume, they're always going to have demand. That's really like, you start to see, it takes about a year before it really starts to show up. because, like you're starting with a small amount of yield, right? So like, you just got to slowly over time build it. But that's the thing, like most people don't look at crypto as a long-term investment. And I think that's where they get wrecked, right? They're not thinking in terms of this is a long-term investment. I don't need to worry about like next month when, somebody gets on YouTube and says that the whole world's ending, and I'm going to pull all my money out. It's like, that's not how you build wealth, right? It's just like real estate. Like that's not how you build wealth.
Yep.
So give us an example of what that looks like. So you've done an excellent job explaining the core four. Show us an example of like a pair that, and we don't need you to give all the secret sauce away, but like, I think it'd be really valuable for our guys to see, okay, so I have this liquidity pair and it feeds this, which then feeds this. Give us an example of one like.
Yeah, and before you get that example, I just want to point out one thing. This is exactly how PulseX is going to work on Pulse Chain to the T.
Oh yeah, absolutely. PulseX is a DEX.
It's a DEX, and it's a copy of everything you have just talked about.
Absolutely.
From the incentive token that Richard's coming out with, and the tutorary, we want to talk about the third party coins that you can make,
absolutely.
the whole enchilada. So, but go ahead,
and that's what has me so interested about wrapping my head around this is, gosh, like if you could know what to do and be ready to rock when PulseX launches. And in fact, we'll talk about that more after Alan shows us a really good example, but I'd love to talk more about what your thoughts are, Alan, in yield farming on a newer DEX and a newer protocol. But let's talk about
brand new chain.
Yeah, I can't wait. I've actually created a liquidity pair on the Pulse Chain testnet with my with my Pulse and my PulseX that I have from the sacrifices, because I just wanted to see how it would work, right? Because that's exactly it. I mean, what you're saying is like, so BNB is to Pulse Chain what and PancakeSwap is PulseX, right? Like they're the exact same things, the same principles, same everything. It's all the same machinery. And so I think that I just want to answer this, and then I'll go to what I'm doing. But I think that obviously the first mover advantage is who's going to get the biggest reward when it comes to any yield farming. And so I think my whole plan is like once PulseX comes out, I've got my once I actually have these tokens that I got from the sacrifice, I'm just throwing them into a liquidity pair, because like as more people are coming onto the chain, and they're going to use PulseX to do it, because PulseX is the only DEX on the Pulse chain, right? So that means there's going to be a huge amount of volume, and most people aren't necessarily looking to provide liquidity. Like they believe in Richard, so they're buying Hex, so they're buying all these other things. We just get to, it's like we get to make the bullets in the war, right? So we just sit back and like rake in the rewards, because initially, I mean, there's a lot of sophisticated people in the Hex community, right? So it's not like they don't know how to yield farm. So I think that it just is how quickly can you get your liquidity into those farms, just so that you can take advantage of really high APRs while liquidity is still pouring in, right? That's my approach on that.
Do you have any well, let's cover this topic since we're on it, and then we'll give an example.
I know I couldn't help myself. I think no, I want to talk about this.
So good. No, it's so
do you have any concerns with providing liquidity? So I've heard a lot of people talk about this, and they're like, well, I'm staying out of the liquidity providing, especially early on, because the volatility is going to be so high. And even though you could get a good return fee wise, you could suffer very severe and permanent loss. What are your thoughts on that?
I think it comes back to your timeline. What's your timeline preference for this, right? Because it will definitely be like moon boys that come in and they just want to be in it for 3 days, and then they're going to take their winnings. And like, often that's then what causes this like crash. It's the people that were like a quick buck, get out. I think if you believe in the project, then yes, it's going to happen. Like without a doubt, that will happen. That's the standard cycle of any, new chain that comes up. So for me, I'm just like, well, I have all of this, like all of these tokens that I got from the sacrifice. So it's not an all or nothing. It's not like I have to put all of them into yield farming, but like it is in my benefit to at least put a good chunk of it in there, because I've already paid for those coins. Right. And so I'd like to see if I get a yield from it. And it's going to have a big jump. It's going to crash, and then it's going to slowly start going up, right? I mean, that's the cycle, right? Like, so I think that all of those people that are worried about that, it's accurate, but like perspective is what matters. Like zoom out and think about like what happens. You know, look at Bitcoin in the early days. I mean, it was up and down like drastically, constantly, and then it slowly started like building over time. I just think that's exactly what's going to happen with.
It always boils back down to the
Pulse.
long-term mindset. Like,
Right.
you know, in
Totally.
the very out the gate, you can see Pulse Chain pumping so hard against Pulse X, and you're going to
Oh,
be
yeah.
stuck with all a bunch of Pulse X tokens. But then, like,
Mm-hmm.
12 months down the road, I guarantee that shift's going to come back the other way. And so if you
Yep.
have the long-term mindset in place, knowing that shift's going to come back down the road, and you're not going to be a day trader and pull those out and take your impermanent loss and lose, you know, that day. I think that's key. That's key. And I'm learning a lot from this. Thank you so much, Alan.
Sure.
More, how to implement more of the long-term mindset into liquidity pools is crucial, man. I love it. It's good stuff.
And talk about, Alan, so as far as percentages for you, so you've got all these PulseX tokens from the sacrifice. How much, and I know this is subject to change, but like how much percentage-wise are you going to take half of it and single side stake it? Are you going to take the other half and LP with another pair of some sort? What are your rough thoughts right now?
Yeah, I'm not sure just yet. I mean, I'm not looking at it as a liquidity event when the chain comes out. So I'm not looking to sell it right away. That's not my plan. So I'll probably do some kind of combination. I think that I'll probably put like maybe 60% in the yield farm, and then like keep, you know, I don't know, maybe put another 20 or 30% in a single side staking. I'm not really sure. In fact, I haven't spent a lot of time thinking about it because, you know, it's always like 2 months away. So I don't know when it's coming out. And I'm like, I'm not going to burn all this bandwidth because who knows what could change between now and when it actually comes out. So I'm like, as it comes out, I'll figure it out, right? Like, but it will be some kind of combination. I'll hold some just to have some in my bag, and then I'll probably stake some, and I'll have yield farming for it. But like I said, I mean, if I'm looking at it as even like a 5-year timeline, it's like, all right, like then it's just going to sit there, and then I don't have to really do anything. I just need to let it sit there. So
right, I like that, and it's cool because as you're generating fees, like you're saying, you can compound. That's been one of the biggest benefits of the positions that I've built over the last, you know, year or so, is even though some of those are down, gosh, a lot of them have thrown off so much passive income that's allowed me to be able to build my other positions and build them pretty strong. I'm actually really excited about them without having to inject a lot more capital. And so this is another way to be able to do that, which is cool, which you've already talked about with the compounding. So give us an example of on the BNB chain of A to Z, like I started here and then I compound and yield shows up here and then I put it here and I earn this. Give us an example of what that chain looks like.
Sure. So I'll use an example of Night Swap. I'm invested pretty heavily in that. So
why did you invest
so
really heavily or more heavily?
I know the creator of the project. I've actually met him in person multiple times and been on a lot of Zoom calls with him. So I believe in the project. Night Swap is really just one piece of an entire ecosystem he's building. Very similar to Richard, right? He's focused a little bit more on how do we bridge real world and blockchain. And so he's a lot of like real world event stuff going on, and then it's supporting the blockchain. So that's why I went with them. But I mean, as you guys know, it's all about understanding who the project leaders are and whether or not you feel like they're legit and like they actually know what they're doing. And so I felt very strongly that this individual knew what he was doing. So inside of there's 5 steps to this. So just kind of I get really excited about it because it's crazy. So all of my liquidity pairs yield night. So I take my night and I put it into a night pool, which gives me a 45% return on my night. So it's just a multiplier of night. Then I take that yield from that pool and I put it into a pool for a coin called Guard, which is like the main coin. You know, like DET is the main coin for DET ecosystem. So Guard is the main coin for his ecosystem that he's building. So I put it in there.
And in the night pool, are you earning more night token?
Yes, in the first one, yeah, it's just multiplying night. So I put in night, I get more night, and then I take that night, I put it into a Guard pool that is going to yield me Guard. And then I take the Guard that's yielded and put it into what they call a Guard Citadel. It's essentially a Guard pool. You take the Guard, you put it into a Guard pool, and then you generate BUSD. So over time, I'm actually like generating stable coins at the end of this, right? And as I get more of everything, I'm just generating more stable coin. Now, I don't spend the stable coin. I actually just invest it back in. I usually like will buy guard with it because it's like a better return to like yield, get the BUSD than it is to get the guard. But that's what I do. So there's these 5 points that all have compounding and equity sitting in them, like that every week I just move it through the system and every week it gets bigger, right? Like I just keep doing that. And that's the beauty. Like I don't know anywhere else in the real world where you can compound and not get rid of your yield. Or you can like say, I'm just going to get these free tokens. Like, so essentially like I'm getting free night, I'm getting free guard, I'm getting free BUSD. Like, and all of that started with my liquidity pair. So the primary investment was in the liquidity pair, and then it's just trickling down, and I'm getting all of this free tokens all along the way, right? So, but that takes time, and that's what I always have to stress with people. Like that did not happen overnight. I've been doing this for a couple of years. Depending on what you're starting with, I mean, if you're starting with $1 million, I'm sure you'll see some real results really fast, but that's not what I started with. But yeah, I mean, think about that: 5 times compounding, and in each of those steps, you also have the ability that the primary asset underneath it could go up in value, right? So, like, not only could the pool value go up in value, then the tokens that you were giving could go up in value, and those tokens are generating more tokens. It's just nuts.
It's nuts.
It's just crazy. Yeah.
So what could, and I know, of course, like we can't on this channel, we never share any financial advice. Everyone needs to do their own due diligence and make their own decisions for themselves. And so this is all just theoretical, or at least my next question. But say that somebody wanted to do yield farming and they had a long-term mindset. Let's take appreciation out of the equation because we can't project that. But what is like, after a year of somebody having compounded and done this, and I mean, and give a rough range. What have you seen so far? We can't necessarily be forward looking and make forward looking projecting statements. But if we look back in the past, if someone would have been doing, some of these pools, like you're saying, what type of returns could they have seen, as they've been building over the last year or a couple of years? What does that look like?
Yeah, I think the answer really lies in how you're allocating your portfolio, because we're purposely keeping a large chunk in an asset that cannot go down in value, but we're also only getting 3 to 5% on that asset, right? And so it depends on like how much you have in your stable versus the others. But I think you can easily, like, a blended yield of 40% is very common over time, right? Like it doesn't start out that way because, especially like if you're starting with a majority in stable, you get very little yield. So it's not, it's going into a multiplier that's, working with a lot less money. But I think like just shooting for that and it's so funny because inside crypto, people are like, 40%, that's nothing. I can run circles around that. And I talk to somebody in the real world, they're like, what? Like 40%? Like, so it's all perspective, right? Like it's just, I'm happy taking a 40% return. Like that is great.
No, I like that. It's good to have more conservative approach. And it's funny that 40% is conservative, if you will, but it's good to have a little bit more conservative expectations rather than like, oh, you're gonna go double your money in 3 months. You know what I mean? Very cool. Very cool. Well, awesome. I think this is probably a good place to end. Corey, did you have any burning questions you wanted to ask?
No questions. Just, appreciate you coming on today. You've educated me, which is one reason why we do this podcast is to educate others and us get educated. So this has been amazing. It's just give me a couple more things to think about on providing liquidity and to prepare myself a little bit for Pulse X, because I would like myself to be able to go on there and do some LPing for the long term. So, I sacrifice for Pulse X. And so, like you said, we've already paid for those coins. Let's diversify some of that, some of the single site staking, and let's learn how to be an LP, because really now when you're learning to be an LP, you're actually bringing value to the chain. you're a very important component in. We all know what happens when you bring value to the real world. You get paid, right? And so this is the same. We're doing a service here, so I love it, man. So thank you so much, Alan. I think we should have you back on in the future.
I love it.
And talk more about this, maybe even after me and Dane, because we're never going to stop learning or stop experimenting around.
Yeah, same for me.
Yeah, I told you, like, literally last week I was when I got wrecked in my last Liquidity pair. So it was like, I'm always, okay, why did I get wrecked? Okay. And I'm learning, every single time, and it's perfectly fine. So
shout yourself out, Alan. If people want to get a hold of you, they want to find you. Are you creating content? How can they reach out to you?
I am. So I've got a Facebook group called Passive Income with Crypto that's free, where I share a lot of my content. And then also you can look me up as just Alan Walker on Facebook. I have my own page called Alan Walker, so you can subscribe there as well.
And I want to make sure that the listeners really understand. I've known Alan for a number of years. Alan is very interested in providing value first. Alan has always been quick to want to help and to share insights. And so I'm telling you guys, I think that the opportunity that you have to be able to access people like Alan in a bear market is very remarkable, because you won't have access to Alan forever. I promise you that as his socials grow and his experience, he's just going to have less and less time to be able to answer DMs and do things like that, because he's going to have to focus on other things. So plug in. Get a hold of the right people that can give you good information that you can trust. I can't overstate the importance of that. We also have a group. In fact, Alan joined our group yesterday. We're really excited to have Alan in. And so if you need help getting started in crypto, or you've been around the block like Alan and you want a community where we can share ideas together and build together and help one another. None of our guys got stuck in the FTX scam or the BlockFi, nor
we
the
actually called it before. We called it before it happened in the group.
Corey called it before, called the FTX crash. We're really interested in helping. And so if we're the same as Alan, if we can provide value, we're happy to do that. So feel free to reach out to me or Corey. You can find us here, of course. Feel free to comment. You can find us on Twitter, on Facebook, on TikTok, on Instagram, any of your chosen platforms. We're happy to help you. And with that, we'll wrap up. Thanks, guys.
Thanks, Alan.
Thanks, guys. See ya.